Okay, so jumping right in here, should I elect a survivor benefit when I retire? Well, there's a lot of things to consider, but let's just start with what are the survivor benefits and how do they work? So the maximum survivor benefit that you can elect for your spouse would be 50% of your basic annuity. And the cost for that would be 10%. So if you predecease your spouse, they will get 50%. The cost of that when you start your retirement annuity is going to be 10% of your annuity. So you get 90% so that your spouse will receive 50%. The partial survivor benefit is 25% of your basic annuity. And so that cost will be 5%. So you'll be receiving 95% of your full gross annuity so that your spouse could receive 25% of your annuity. Okay. So here's some numbers in place there so you can get an idea of how this works. So if someone had a $3,000 a month basic annuity and they elected the full survivor benefit, they would be electing to receive a reduced basic annuity of $2,700 a month. So that, $300 comes off the $3,000, and now their spouse, should they predecease their spouse will get $1,500 or 50%, right? So the partial survivor benefit, using that same basic annuity of $3,000 a month, now that individual would receive a reduced basic annuity of $2,850. And so that cost there, as you can see, is of 5%, is $150 a month. And then so this way now their spouse is going to receive $750 a month if they pass away before their spouse. Okay, so there's a lot of considerations here, right? You need to understand how it works, the math of it, of course, but there's other considerations that are key. FEHB, which is the Federal Employee Health Benefits, is linked to the survivor benefit, right? So in other words, someone has to be receiving a FERS annuity, whether it's a retired annuitant or a survivor, in order for federal employee health benefits to be available or for eligibility there. That makes sense. So if you do not, just to clarify, if you do not select a survivor benefit for your spouse and you are still alive, your spouse is still eligible for the health insurance through the federal government. If you predecease them and you do not have a survivor benefit, they are no longer eligible. Okay, just to be super clear on that. Outside life insurance, if you have outside life insurance, it's already in place and you plan on keeping that long term, that's something you're going to want to factor in. And the survivor benefit, what you don't want to do is pay too much for something you don't need, right? We don't want to be overinsured. And so we want to make sure that if we have enough through outside life insurance, that maybe in your situation, you may not need to do the maximum or some variation of. So just giving examples here. Other assets that you have. You may have rental property, you may have received an inheritance, you may have just been diligent savers and you have plenty of money socked away in the TSP and other outside accounts to where you're self-insured. So if something happens to you, you don't necessarily need for your spouse to receive a portion of your pension because you guys have done a nice job in other areas of your financial life. And low debt is another example of where that can be real helpful if there's no mortgage or something like this. Longevity, that's also something to consider. I know it can be a little bit of a strange thing to consider, our own, mortality, but, if your spouse has family members who have lived both into their 90s, their parents are all in their 90s, and then your parents passed away a little bit younger, well, then maybe that could be something that would be a factor in the decision of getting a survivor benefit for them, right? Age difference, of course, that's important too. There's a big age gap between you and your spouse. Know this, that the survivor benefit does end with your spouse. So that's that. Whereas life insurance can go to other beneficiaries. Taxation. So the federal survivor benefit is taxable as ordinary income. Whereas, if you were to have outside life insurance, sometimes there's some benefits there. Generally speaking, life insurance is tax-free. So there's something, to think about there as well. And review overall estate plan. So again, just kind of, this is something that we talk about as financial planners a lot with clients, is review your overall estate plan at least every 5 years, or when there's major life events with your family, that are going to be something that needs to be considered there.